Hey, I'm here with Brad Lyons, our research and investment manager here at Wise Wealth Management, and we have some information about some research that we found getting ready for a podcast, which we'll post on the 17th on active versus passive investing. And just to kind of tee this up just for a second, in the active versus passive debate, a lot of times everyone says, well, it's really hard to beat the S&P 500, so you buy the index. But in other areas like small caps, you're better off with an active manager, meaning buying a typical mutual fund that's more actively traded versus just holding the core index. What's interesting is that, Brad, you pointed out that that's not the case anymore.
No, that's changed a little bit. And in fact, it may even be that the debate is over relative to passive versus
I think the debate's
active.
been over for a long time, but a lot of legacy advisors don't think so.
Well, the debate, as you alluded to, went on for a number of years in the small cap and mid cap asset class category. But what we're finding is through research that even in the past 12 months, 78% of small cap managers were unable to beat the index. 78%. And if the news is even worse for longer time periods, Casey. Over the last 10 years, 84% of active managers were unable to beat the index. And even longer than that, 20-year period, 94% of all active small cap managers were unable to beat the index.
So most of us are going to be invested for a 20-plus year period.
That's right.
You know, pre-retirement, you have all that time, plus we always plan people living to age 95 or 100. So that's a long time your money has to last. And what you're telling me is if I just buy the Vanguard or the BlackRock small cap index fund, I have a 94% chance of beating any active manager out there.
That's correct. That's
amazing.
What the research is showing. Now, the reason the debate went on for so long is because that in the small cap space, for example, there are fewer analysts covering these companies, doing their financials, listening to conference calls, and doing research on the company itself. And therefore, it was thought that perhaps an active manager could find a company or two or three or four, however many they wanted in their portfolio, at least enough that they could get outsized returns by investing in companies that weren't otherwise covered by other analysts. Because once an analyst does a research report, they publish the report. And once the report is published, it becomes public information. Actively managed funds by active managers, in the past, it was believed that they could find these companies that weren't being covered, find out the information, exploit that information by making investment decisions that they could profit from. That's becoming less and less so anymore. And there's a couple reasons for that. One is obviously, there's more analysts covering more companies. And two, any investment manager now can purchase a software program to get updated financials on just about any publicly traded company.
Right.
And then they could follow conference calls, they could do their own research, and there's so much available on the internet that it's just difficult for there to be any non-public information, to find any non-public information that you can exploit.
And fees have a good...
fees are huge,
big
Casey.
difference too.
The average small cap actively managed funds fee is 1.61%. 1.61%.
And then the index fund costs how much?
0.06%.
So 0.06. So they have basically a 1.6% headwind they have to overcome just to get to the break-even mark.
Just to get to the break-even point.
Yeah.
So, and it's going to become even more and more difficult going forward in the future for active managers to consistently outperform their benchmark in the index. And for those that did, congratulations.
Right.
Good for them. But at some point in time, 60% of those managers trailed their benchmark by greater than 20% over that time period. There aren't many investors who will withstand a 20% lag in the benchmark that they were expecting to return.
Many of them would jump ship.
So they jump ship.
Yeah.
That's right.
Morningstar had a study a couple of years ago. It basically says that to be successful with active managers, you're going to have to, typically they have 3 good years, 2 really bad years. So you have to hold them for the 3 good year period, sell them when they're at their peak, and then move into another manager that has had 2 bad years in a row, which means there's a sign that they could be moving into their 3 good years. That's exhausting. Not only is it exhausting, but it's also not very tax efficient either. to go through that process.
That's right. That's a great point.
This is we get into this more in depth in our podcast. We'll post January the 17th on active versus passive investing. Hope you learned a little bit through this talk. Be sure to download the podcast.